Unlike previous stock charts, this example with Ford stock shows a chart trading at lower prices, in some cases under $10, but that does not matter since candlestick charting can still be used when stocks are trading at much lower prices as well. A clear downtrend places a bearish tone on the large upswings. Naturally, this leads to upper wick rejection with several very clear bearish stars forming. The downswing here takes a while to form. However, once the large red volume begins to close strongly below these bearish stars, the market returns down once more. The trajectory is still overwhelmingly bearish despite the minor upswing recently. This current candle is certainly no bearish star, however it still exhibits the general price action of upper wick rejection within this sliding resistance zone, coupled with the increasing selling volume occurring right now. Another downswing is quite likely, especially as this next candle strongly closes lower as well. A definitive downswing does indeed occur with adequate volume. This is indeed a bearish engulfing pattern, as the first green candle continuing the minor upswing is fully contained within the real body range of the second larger red candle. A classic continuation lower with the general price action of a falling three methods, except on a larger scale over several weeks. A bull hammer does emerge with some slightly higher than normal volume. However, the drop continues and there is certainly no upswing because the next candle doesn't even trade above its high and instead closes lower. This later dragonfly doji has more success in halting the downtrend and even putting some bullish sentiment into the market, as the next candle immediately closes over its high. In fact, this is a bullish engulfing pattern. The dragonfly doji has its real body fully contained within the real body range of the larger green candle that follows it. This leads to a neutral to increasingly bullish sentiment in the market, and despite this spike down, these two bull hammers in particular keep the market aloft and in a more narrow range to eventually contact and surpass the 1450 level, the first major relevant resistance level. This is passed once again, not with overwhelmingly high green volume, but it is consistent overall and slightly above normal levels. Another familiar sight is that the 1450 level comes from the lower boundary of this downward continuation earlier, where there was a heavy concentration of selling. And looking at the longer term context, the 1450 to 1330 range had also been of major significance in the past, having influenced several major reversals years earlier. So it's no coincidence that the low of the dragonfly doji is very close to this round 1330 level. More familiarity here as single candle reversal patterns are emerging, both in downswings and upswings of various sizes. Despite this being an overwhelmingly large bull hammer, it still shows the same general price action of more normal sized candles with strong lower wick rejection and a green real body concentrated towards the upper third of the candle. These two swing points with dojis also demonstrate dojis in a directional context. Further into the future, these same two levels still have a major impact in the market. Here is a good example where bullish reversal candles in an established downtrend do not lead to an uptrend. Price does not immediately trade above the high of this inverted hammer. It does so for this dragonfly doji, but it closes lower, and eventually the market continues the downtrend. Same thing here with the bull hammer. The market briefly trades above, but is unable to maintain, continuing the row of red candles as well with increasing selling volume. Another good reminder that candles are never a guarantee on their own, even if they are strong bull hammers. They still need to be coupled with dynamic analysis of current developments and a look at the broader context. There are also a series of bullish reversal candles here. However, the decisive factor in this case is the current large green candle with increasing volume that effectively engulfs the past week of price action for a huge bullish engulfing pattern. Now for a major reversal back to the upside, it is best that the market immediately close above the high of this bullish engulfing pattern. This does indeed happen with increasing volume too, leading to a very steep incline to reach the $12 range, and at this point there is natural resistance up even towards $12.50 due to this lining up with past ranges of indecision and failed upward reversals. A look back at the longer term context also sees 11.1 as a major lower boundary in the past as well, and this added to the supporting potential in the November upswing. A steep upswing during a volatile period centering around 11.1 with a piercing pattern for this minor upswing. To clarify the price action here, it is helpful to combine the candles at these upswing points to see that there is generally lower wick rejection and bullish intent with price closing higher. Eventually, the market reverses back down with a green kicking pattern where the gapping candle is a gravestone doji. This leads to an extra bearish context prior to the acceleration with increased selling volume, and on July 26th in particular, there is a bull hammer right on the major 11.1 level. However, it only serves to slow down the descent because even though price closed above the high of the bull hammer, the volume was normal to low, and that was in sharp contrast to the bearish volume and candles that continued in quantity and quality in terms of their persistence down to the next major level at 1050. A promising sign when the current candle trades above the high of the recent bull hammer. However, this is not enough. The next few candles also need to continue the bullish momentum in the short term and eventually close above the high of these last two candles. This does indeed happen, and the market becomes gradually more bullish with increased volume as well, which is more than enough to overcome this strong bearish star at the natural first major 11.1 resistance to continue the uptrend further. In the short to medium term, the situation looks promising. However, in the longer term context, Ford stock price continues to decline, and along the way the 10.5 level is reached during a steep uptrend. However, it too is reversed back down from this major double top. That first begins with a candle that is almost fully bearishly engulfed. It is essentially a dark cloud cover that closes much lower than the halfway point of the first green candle.